Hello, everybody, and welcome to our 2021 Economic and Market Update. I'm Don Houston with United States Investors International at LPL Financial. Now, today's agenda is very straightforward. First, we're going to share with you some economic and market updates, and then we'll also discuss some proactive guidance moving forward. Now, before we begin, there's 5 key areas of financial planning, and it's always important to review the preservation planning, retirement planning, tax planning, estate planning, and investment planning. Now, as a comprehensive financial services firm, we try to always consider the impact of any recommendation that we make on not just one, but all of these areas for our clients. Today's presentation is primarily focused on investment planning and the equity markets. At our firm, we partner with our clients and believe an educated client is our best client. So while we always try to help, try our best for you to get the best information that we need, we believe knowledge is power. And one of our missions is to share with our clients any knowledge that can help them make informed decisions. Now, this update is kind of combining both the end of the third quarter with what happened in the fourth quarter and what we're moving into. As a matter of fact, today is the 22nd of December. And so for those of you having birthdays today, my mother-in-law's birthday is December 22nd. Happy birthday, Mom. I hope you had a great day today. And the rest of you that have late birthday Decembers, happy birthday to you too. The month of September, going back to our equity markets, has been what we'll say trouble, but essentially, history repeated itself again. Septembers are difficult for both the S&P 500 and the Dow, and this year, history repeated itself. It's one of the weakest months for equities over the past 20 years. The third quarter started relatively strong during the summer. As you remember, we had some COVID Delta variant strain at that time. That kind of, weaved its way into, the economics of what we had going on. And the S&P 500 experienced its worst monthly performance since March of 2020, which is, the month of, when the pandemic actually hit. And we started with this COVID-19 process that, we've all kind of maneuvered through over the past year and a half plus. A combination of factors continue to influence the market in the direction of the equity markets. And some of those concerns are the rising inflation expectations, the impending interest rate changes, which we see this stuff in the news, frequently, and then of course monetary policy changes, which are kind of going hand in hand. And then we see the new continued COVID-19 concerns with the Omicron and what's happened here. And I've seen some news here recently that the Omicron strain, some very famous learned people have actually came out and said here over the last week or so that they think that's, we could see the light at the end of the tunnel here. This Omicron could be the beginning of the end for the COVID-19 strain. That doesn't mean we're going to have other issues and other stuff that we always deal with as humans. And remember that we've been remarkably resilient. And so if you really think about what's happening, around the globe and what happened to us during the COVID process from the beginning of the whole thing back in March of 2020, all the way through, today, we've been relatively resilient. I mean, we've done some things that have made things work. We've shifted. We've been dynamic. We do all these things that humans do, and here in the United States, it's been no different. And we've done it all over the world this way. There continues to be major factors in determining the future direction of our economy, and potentially could cause some volatility for investors in the near future. But never rule out the resilience of not only humanity, but business and the way we do what we do. And we'll continue to do that. Now, the Federal Reserve Committee, they met in September. And at the time, they were talking about, labor markets continuing to improve, and they have. And we're still seeing that, pretty much even keeled across the board. They talked about tapering, and which what that means, they're going to reduce the purchase of treasury bonds, which would begin in November, and they did it. As a matter of fact, they didn't raise rates; they kept rates low, 0 to 0.25%, and they've actually indicated that they're not going to raise rates until the tapering is over. So they've started the tapering process. We're not buying as many bonds as we were, and we're going to actually move that down to zero as we get into near the mid or end of first quarter 2022. Now, at that time, we may see our first increase in rates from the Federal Open Market Committee, and the Fed Chairman Jerome Powell has suggested that after the tapering reduction is done, then we may actually start seeing an increase in the rate environment, and that's because of the inflation being a real concern, and it certainly is for savers because it eats into our purchasing power and our lifestyle. So it's a good idea for us to try to keep pace or exceed rates to inflation, and we're keeping an eye on inflation just so that we can make sure that any changes that affect us or impact us, we're on top of what's going on here. The 10-year Treasury yield finished out third quarter at 1.52. I just saw the other day it's 1.46. So it's not like we're in a downhill slope here doing any downhill skiing. We're kind of doing some cross country skiing here and just kind of cruising along and staying relatively flat. We've got long-term expected inflation is around 2%. We've seen it bump up more than that. We don't think that it's going to be a long-term process. So we'll see how this all plays itself out. Essentially, equities is where you want to be when you have, an inflationary environment and a rising rate environment that all kind of is looming on the forefront here. Now, safety comes with a cost. We've seen what interest rates banks are currently offering to our savers, which is not anywhere near what inflation is. So, we look at, the Barron's report here, and their report shows that average bank money market rates in October of 2021 for 0.07%, and the average 12-month CD was about 0.15% on an annualized yield. Well, there's a silly statistic out there. Annualized yields of 0.15% without taxes would take 350 years to double our money. So, that's kind of a silly thing to say, but obviously, these ultra low rates aren't going to help us reach, our outflows if we're using our money, to continue to generate income over time. So equities are a big part of a diversified portfolio. Now, as our chart shows here, since 1950, the fourth quarter of the year has empirically been the best quarter for equity markets. Now, remember that prior performance never indicates, future performance, and there are still many key factors that could impact the direction that we see, equity markets move. And we have all these things that are happening out there: the rising inflation expectations, impending interest rate changes, monetary policy changes, tax law changes, and then of course the continued COVID concerns, and we've talked about all those things. We think we've got kind of a handle on how everything looks like it's going to work out for the major direction of the economy. So overall, 2021 has been a positive year for equity investors, and historically, a positive first half of the year leads to a positive second half. And so here we are, coming into the end of the year, and we're starting to have a rally. They call it that, the Santa rally, right? Santa Claus rally. Again, no historical results or the future indication, but we think that, we're going to do okay in the equity space. We've got to be cautious about our bond space, and we're doing it. So we're looking at equities being the place to be here coming into 2022. And of course, we're very cautious. It's a natural, healthy, and smart way to handle our money, and that's what we're doing. Investors should seek to become aware of their behavior in times of volatility as well as opportunity. So being too fearful or overly optimistic can many times lead to poor decisions, and your emotions can make you reactive instead of proactive as an investor. And so, knowing your risk tolerance and how to navigate not only volatile times, but also, being impulsive or, having too good to be true opportunities, and or the fear of missing out. I mean, that's another term that, a lot of, you'll see a lot of folks use. The key is just to stick to our goals and stick to our personal situations. I mean, you see the chart here, some of the old sage investors we see in the news here and there, and they quote these guys or talk about them anyway, and you've heard them say, I mean, sell when, everybody else is elated, and buy when everybody else is scared. And so, we kind of maneuver through those cycles and continue to add value to our portfolios, no matter what kind of market situation that we have going on. there's four major things you should have a grasp of to help you maintain discipline and direction toward those goals. And the first one would be risk tolerance and your appetite for risk. And so by this, I mean, how much risk are you willing to take? And how much can you afford to take? And then what's your time horizon? That's the second one, is time. The amount of time you want to be invested in any situation can help you determine entry and exit points. And sometimes we'll have some stop losses, on the downside, and we'll do some different things that you'll want to help us manage what we're doing depending on market situations. And then of course, behavior. Your behavior during market volatility is part of the investing experience. It can create anxiety and stress when there's superior volatility, and we've seen a bunch of that over the last several years. And so, how do you handle the ups and downs? And truly, that's an impact. And your overall strategy, that would be the fourth thing. Are you looking at something that doesn't quite fit with your overall strategy? And we see these things in the media, like we should do this, we should do that. The cryptocurrencies and the other stuff that's out there. Do we really want to make any rash decisions on trending investments? And really, we don't. We're going to just stick to our overall strategies. We're going to just be conservative and continue to monitor what we're doing. We don't want to have any odds that influence trending investment issues that cause us to get out of bounds. And so we want to, essentially take advantage of new opportunities when they arise, but they might not all be, the right opportunity for our strategies. And so we'll continue to focus on, just staying the course and having predetermined and even exit points when we need to for investing strategies. But for the most part, this sounds a whole lot like trying to time the market. And I can tell you, from my experiences and all the experiences that I know of in the history of investing, that it's probably impossible. I mean, some people, claim they do this or that during certain times, and perhaps I can tell you that we always want to have some skin in the game. We're going to have some stocks, we're going to have some value, we're going to have some growth, but we also might have, more cash than we usually do, and that's kind of been the theme for the last couple of years. Is we kind of hold back some cash, and we don't have any. We want to make sure that we do. There's lots of the things of these conditions that we just talked about, with things that are out of our control that we can take advantage of when some things cause things to happen. So recently we just did not get our Build Back Better plan passed through Congress, and so when stuff like that happens, we can see some impact that potentially could be causing some grief in the future, and or perhaps causing some wellness in the future with what we're doing in the markets itself. So being cautious is a good thing. Here are some key items that we want you to take away from this video. I want you to understand that caution is still the principal notion for investors. Interest rates are still near zero, but they're going to go up, and it looks like they're going to rise sooner than later. Let's just say that. Inflation continues to be a concern. So that's kind of a big deal. Is it transitory? I mean, it doesn't seem transitory, when you're a family buying milk, I can tell you that. So, and, the prices for gas and the other stuff that we're doing just to get around and navigate. And also, the shipping of goods and stuff like that. So it seems like, rates are going up. We know that. And then what's that going to do to our bond markets, which leads us back to equities and, and our dividends and yields from our equity investments are the best thing for us, at least, to pile together here as we move into 2022. And always, we are here to help you. So what can you expect for us? One of our main focuses is to review changes for our clients on an ongoing basis, which you see that, we're doing that here, and you can continue to expect regular communication, maybe even more frequently and more frequent discussions than, we've even had in the past. And we try to stay in front of you for sure, with any updates, and especially economically with what's going on. And the tax law changes, that's the other thing that we didn't get when we had this Build Back Better plan didn't pass. I mean, there's some tax change in there that seemed like it could be really impactful, and it just hasn't happened. So as these things change, into the next quarter and following into 2022, we'll make sure that we update you. We're continuously reviewing economic, tax, estate, and investment issues for you. And in fact, we're going to offer other workshops so that we can highlight any changes that are coming up and plan, for the new ideas that we'll need to take advantage of the change where we can. As a client benefit, remember that you can add to our mailing list for viewing these workshops. And we hope you take advantage of it and add a couple of names to our list. We certainly appreciate you and all of our clients. You know, it's one of our goals is to continue to help other people. And some of our best clients were referred to us by existing clients. So please, you know, continue to add to our list here. If you have any questions, just please give us a call. But you can certainly, you know, call into our 360-694-8111 and get one of our team and, you know, just add folks to our list. We have our disclosures on here. As I sign off, you know, you can see the Northern Lights behind me. I selected that for a reason. It's nearly Christmas, you know, in a couple of days, Santa and all of his elves and the reindeer are going to take off and they're going to deliver all over the globe. You know, I certainly hope you take this time to have a wonderful holiday season. You know, holiday cheer, family and friends, and, you know, from my family to yours, happy holidays. I look forward to seeing you next year. And until next time, make it great. Happy New Year, everybody.